Welcome to Finance Deep Dive. Today, we're going to open up the playbook of the one institution that quietly but powerfully steers the world's largest economy, the U.S. Federal Reserve. We're going to break down how its decisions directly shape your financial life. Have you ever wondered about that? Well, the answer, way more often than you might think, points right back to the Fed. So in this video, we're pulling back the curtain on exactly how this powerful and, let's be honest, often mysterious entity actually works. So what's the Fed's ultimate goal anyway? What are they trying to do? Well, it's not just about managing money. It all boils down to a very specific two-part mission that it got directly from Congress. And this right here is the crucial point. These two goals, keeping people employed and keeping prices stable, are often pulling in opposite directions. I mean, think about it. If you hit the gas to create jobs, you risk sparking inflation. But if you slam the brakes to fight inflation, you could cost people their jobs. It is a constant, delicate balancing act. So how does the Fed even attempt to pull off this balancing act? Okay, let's get into the standard toolkit, the everyday tools it uses to either press the gas or hit the brakes on the U.S. economy. The Fed's main lever of power, its number one weapon, is something called the federal funds rate. You should think of this as the master switch that controls the cost of borrowing money across the entire financial system, for literally everyone, from huge global banks all the way down to you. And that gives the Fed two basic moves. When the economy is kind of sluggish and needs a boost, it uses an expansionary policy. It lowers rates to make borrowing cheaper and get people spending. But when prices are rising way too fast, it flips to a contractionary policy, raising rates to make borrowing more expensive and, well, cool things down. Okay, so let's trace the domino effect. Let's say the Fed announces a rate hike. What actually happens next? How does that ripple through the real economy? It all starts right here. The first thing that happens is that it gets more expensive for big commercial banks to borrow money from each other overnight. This immediately raises their own fundamental cost of doing business. And, banks don't just absorb that higher cost out of the goodness of their hearts. Nope, they pass it straight on to us in the form of higher interest rates on mortgages, car loans, and credit cards. And, of course, more expensive loans for businesses that want to expand. And as you can see, it is a clear chain reaction. Economists have a fancy name for it, the monetary transmission mechanism, but all it really means is that a single change at the very top flows all the way down, making money tighter, which slows down spending, and ultimately helps to fight inflation. Okay, that's the standard procedure. But what happens in a major crisis? I mean, what if things get so bad that cutting interest rates to zero just isn't enough to fix the problem? Well, this is when the Fed turns to its emergency kit. They break out the unconventional power tools, like something called quantitative easing, which you've probably heard of as QE. Now, to get a sense of the sheer scale of these emergency actions, just look at this number. After the 2008 financial crisis, the Fed used QE to expand its balance sheet from around $800 billion to an absolutely unprecedented $4.5 trillion by 2015, just a staggering amount of money. So how did it work? By buying up trillions of dollars in bonds, the Fed basically created massive artificial demand for them. This pushed bond prices up, and here's the critical part. It pushed their yields, which is just another way of saying long-term interest rates, down. The whole point was to make borrowing cheap for everyone and get the economy, which was on its knees, spending and investing. But the Fed's job isn't just steering the economy. It has this whole other critical role that became front-page news in 2023. Making sure the banks themselves are actually safe and sound. One of the key tools they use for this is the CAMELS rating system. It's basically a report card for a bank's health. Each letter stands for a key area they look at: capital, assets, management, earnings, liquidity, and sensitivity to risk. And believe me, a bad score on this report card is a huge red flag for regulators. And this whole system faced a massive real-world test during the banking turmoil of 2023. The collapse of Silicon Valley Bank happened with stunning, terrifying speed. The irony is, it was the Fed's own rapid interest rate hikes that made the bank's bond investments lose a ton of value. And once that news got out, it triggered a classic bank run. But this time, it was supercharged by digital banking and social media. So to stop that panic, that contagion, from spreading to other banks, the Fed had to act. And they had to act fast. They immediately launched a brand new emergency lending facility called the Bank Term Funding Program, or BTFP. The BTFP was a really crucial backstop. It was actually pretty clever. It let struggling banks borrow emergency cash from the Fed. But here's the trick. They did use their bonds as collateral, valued at their original price, not their current beat-up market price. This one move allowed banks to get the cash they needed without having to sell their assets at a huge loss, which is exactly the fire sale that sank SVB. So, as we've seen, the Fed is constantly walking this tightrope. It's using these incredibly powerful tools to balance the risk of a recession against the danger of runaway inflation, all while trying to keep the entire banking system from tipping over. And that's why this all matters so much. From the interest rate you get on your savings account to the cost of your mortgage to the stability of the job market, understanding the Fed's playbook is really essential to understanding the powerful forces that are shaping our economy every single day. And all of this leaves us with a pretty critical question for the future. The economy is always evolving. We have new challenges, from digitally fueled bank runs to global shocks we can't even predict. So, will the Fed's current playbook, the tools that worked for the last crisis, be enough to handle whatever comes next? Thanks for watching.